Hi, everybody, and welcome. I'm Leslie with the New Mexico Small Business Development Center, and I'm pleased today to introduce everyone to Tommy Thompson. Tommy is a certified SCORE mentor, and we are really excited to have him because he's been giving us a great series on Cash is King, cash management for your small business. I'm going to be chatting over a couple of links for you. So watch for those throughout the webinar. I also want to remind you that any questions that you might have, go ahead and type them into the Q&A because we will pick those up throughout the webinar when we can get a break and answer any questions that you may have over cash management for your small business. Tommy, I'll turn it over to you.
Leslie, thank you very much, and good morning, everyone. Thank you for joining us this Thursday before the Labor Day weekend. Hopefully you'll labor today and then you'll be able to take the rest of the weekend off. Yeah, I know Friday isn't part of the weekend, but I also know a lot of people take it off. But welcome. We're going to talk this morning about cash management for your small business. As soon as the program wakes up and starts giving me advances and the slides work properly, that is, as well as being a SCORE certified small business mentor for the SCORE Association, which is our strategic partner with SBDC for this program. I'm also a retired financial executive. I have a 35 to 40 year career in financial management. I get to put a lot of letters after my name. They include CPA. Again, I'm retired. But I've got a lot of experience in financial management, getting businesses to stay on the right track, to predict where we're going, to help get us there. And I'm hoping that you'll appreciate that it applies here quite well. Some presentation guidance. Your audio has already been muted. Make sure you set your Zoom ratio down there at the bottom of your screen. There's a little menu bar. Set the Zoom ratio to fit window. That way you'll see the largest possible typefaces and things like that are going to be on our slides. As Leslie said, we will be using the Q&A function to take questions. Please write down the question that you have and the related slide number so we can go back to that when we come to the questions section. If you write your questions down as they occur to you, Leslie will break in every once in a while at a stopping point to ask me to address those questions. So we will try and get them before the end of the program. Now, today, what we're going to talk about is we're going to talk a little bit about what SBDC offers in terms of training and counseling assistance. We're going to talk about the objectives of this program. Then we're going to talk about this program in terms of cash flow management and the required record keeping you need for some of the pandemic related programs that are out there that can help you. We're going to take your questions and we're going to talk a little bit about next steps that you can do to help you realize that cash is king and that you need to be treating it that way to make your business successful. First of all, for those of you interested in other training opportunities besides this one, you can go to the NMSBDC website at nmsbdc.org to request to find the training offerings that are listed there for cybersecurity, pandemic response, and several other topics. Also, you can request no-cost business counseling and loan application assistance at that website. So nmsbdc.org is your go-to site for those things. This morning, we're going to talk about what is cash flow. You might think you know, and we're going to both either confirm your knowledge or add to it. We're going to talk about what makes cash flow. Why does cash come into your business? Why does it go out? We're going to talk about some strategic cash flow management principles so that you understand what it is you have to be doing to keep cash flow at the top of your mind and to get the tools you need to effectively manage it. Then we're going to talk about forecasting cash flow, which is a critical first step in getting a handle on what your cash flow is and how it's expected to show up and go out of your business. Then we're going to talk about some tactical cash flow management techniques, both to speed up cash coming in and to slow down cash going out. And finally, we'll be talking about some record keeping requirements for pandemic relief. It's more than just entries in the computer file. I'll tell you that right now. And then finally, as we said, we're going to talk about some next steps. Now, what you have to remember in your business, and the point of this whole seminar, is that cash is king. It's the lubricant that makes business run. Without it, business grinds to a halt because it can't do anything. It can't pay anybody. It can't meet its obligations on time. When you run out of cash in your business and all that stops, then you crash. So you have to watch out and keep cash and cash flow management right at the top of your mind. It's right up there with getting new customers. It's right up there with getting the work out of your shop or the goods out of your factory. It is king to your business. Now, what is it? I like Yogi Berra's definition, and they pay in cash, which is just as good as money. Yogi was good for a lot of those isms over his lifetime. In a more formal way, cash flow is the net amount of cash and cash equivalents, that stuff that becomes cash immediately, that are transferred into and out of your business. At the most fundamental level, the company's ability to create value for shareholders, that's the value of the business, and increase that value, is determined by its ability to generate positive cash flow, to maximize the long-term free cash flow. When I say free cash flow, I mean cash that isn't needed for anything else in the business. It isn't needed for expansion. It isn't needed for supporting asset levels. It isn't needed to pay stakeholders. It isn't needed to pay dividends. The free cash flow that can be returned to an investor is what a business's value is based on. Now, what makes up cash flow? First of all, you may know this. It's cash money coming in. It's cash sales. It's collections on accounts receivable. And we'll talk about this. When you sell something on credit, did any cash go anywhere? It didn't, did it? So that's not cash flow. But the collections, when the money comes in the door, that is part of cash flow. Deposits by your customers, prepayments by your customers, those all make money coming in. Now, that's part of your income statement generally, because it's part of general business operations. But also, other sources of cash do contribute to your cash flow. One such source is pandemic relief loans and grants from the Payroll Protection Program, the Economic Injury Disaster Loan Program, City of Albuquerque Small Business Assistance Programs, all of those kinds of things. Also coming in, money from bank loans, loans from you out of your pocket to your business, and also cash from family, friends, and fools who've been persuaded to either lend money or invest money in your business. That's cash coming in. Cash going out, of course, is everything you pay people to do. It's compensation to your employees, it's benefits and taxes on their behalf, it's payments on accounts payable. Remember, when someone sells you something on credit, it's yours, but you haven't paid for it yet. When you pay for it, that's cash flow. It's rent payments to your landlord. It's operating expenses paid to all the vendors that you deal with. All that is when the cash moves and when the cash goes out. Also, and that's part of your operating statement. Usually that's part of your profitability. But other things enter into cash flow out as well. And they include bank loan repayments. The principal portion isn't part of profitability. Capital equipment purchases, which are not part of profitability. Owner draw, which is free cash flow coming out to the owner. And also stakeholder payments to family and friends in terms of repaying private loans or paying dividends on investments. All right, that's all cash going out. Now you can see that cash flow is different from profitability. There are more sources of it and there are more uses of it. Sources coming into the business, uses going out. It's also important to recognize, as I mentioned up at the top, what isn't cash flow. Anything that happens on credit, whether it's credit given to a customer, you ship a good, you expect a payment later, or whether it's purchases from a vendor. He ships you a good, you pay him later. Those sales on credit, purchases on credit are not part of cash flow. We're interested in the hard money, the coin coming in and the coin going out, and promises to pay and promises to pay vendors, promises from customers aren't part of your cash flow. Now, basic strategy. In order to effectively manage cash in your business, you have to work at it. It has to be at the top of your mind. It has to be focused. You have to be focused on it just as much as you're focused on getting new customers, just as much as you're focused on servicing your existing customers, just as much as you're focused on getting goods produced or services provided to people. You have to work at cash flow. It needs to be in the top of your mind all the time. Now, to help it be in the top of your mind all the time, you start by forecasting it. We'll talk about forecasting techniques in a minute, but you have to forecast it. You have to have some funny idea of when it's going to be coming in and when it's going to be going out, so that that gives you a baseline to say, oh, that's different from what I thought. Why is it different? How do we change our management to meet that difference? Now, in order to decide whether you have the information you need to check on your forecast, you have to track cash flow. You can do that with almost every computerized accounting system that exists today. And we'll talk about that and talk about tracking it and using your systems to track these things. Now, after you have some idea of what should happen and you have a tracking mechanism to find out what is happening, then you can apply some techniques to accelerate your cash coming in and slow down your cash going out. Now, that question mark at the end of slow down cash out is not an accident. All right. Those of you who have worked who work small businesses and are working with your small business may be scratching your heads, wonder, how do I slow down cash going out? And we're going to talk about that as we go through here. But we're going to start out with forecasting. Forecasting basically asks 4 questions. What's my cash right now? What's coming in? Why is it coming in? And when is it coming in? And then what's going out? Why is it going out? When is it going out? And then finally, after all that, what's my cash at the end of the period, whatever period you're talking about? All right. Now, I want to say that I'm very much indebted to an author named Philip Campbell, who has provided me the permission to use this forecasting template model from his book, Never Run Out of Cash, to talk about how we forecast cash. And the template model is one that's a live model that you're going to be able to get from the NMS-BDC website. Leslie can provide you the links on chat and so forth as we go along today. Now, section 1 of this looks pretty, pretty common, pretty much like your operating statement. There's a couple of changes though. Up there at the top, we have a beginning cash balance line. That doesn't appear on your normal profitability statement. By the way, this template model that you're going to get is for a full year. And I've just taken the first 6 months here so that the type is big enough for you to read on your screen. Section 1 starts off with revenues from sales and other revenues, just like a normal operating statement. Puts in cost of goods sold like a normal operating statement. Comes to a gross profit number, then takes out operating expenses from all of your different operating expenses. But the number down at the bottom isn't labeled net income. It's labeled something funny like EBITDA. Now that stands, as it's noted there, that stands for earnings before interest, taxes, depreciation, and amortization. And that's a common proxy for cash flow that's used by professional financial analysts when they analyze public company financial statements. In this case, it gives us a line that says this is roughly what your operations are generating in terms of profitability, cash flow, if you will, okay? Disregarding the timing differences with respect to receivables, collections, and accounts payable payments, all right? Now that gets you to that number. The second section of this and the third section of this are things that don't normally, at least not wholly, appear on your profitability statement. Debt service is combined of both principal and interest. And remember in the previous slide where we showed you the earnings before interest, Here's where we account for cash flowing out due to interest. Your debt service is a combination of principal and interest. Many bank debts are paid in level payments that have some principal and some interest in them. So that whole payment is cash flow out, and we put it in here in section 2. And in section 2, in debt service, we could also put in sources of capital from new loans, for example, and they'd be a positive number coming in. Section 3 talks about investments of our capital, and those include capital expenditures and anything else that we put our cash into. It could be land for future expansion. It could be, it could be marketable securities, putting them away for a time in the future. It could be an investment in a subsidiary. We acquire a business from somebody, all right? But those most commonly in a business, those are capital expenditures that we're accounting for here, and they're generally cash going out. Now, section 4 reconciles all of this because it accounts for the timing differences between receivables, payables, cost of goods sold, inventory purchases, and so forth. Now here what we do is we add back the cost of goods sold, because in this example, this is a goods business, okay? We manufactured those goods to inventory in some prior period, all right? And we paid their production cost in some prior period. So we're gonna subtract that from our EBITDA number, and we're gonna add that back to our EBITDA number. Excuse me, I misspoke. And then we're gonna take out inventory purchases, the cost of putting things in inventory, all right? And those costs could be raw materials, they could be direct labor, they could be supervision, they could be any other factory costs that we paid in that period to put assets into inventory. Now, we're also going to deduct sales, because sales, not all of our sales are made on cash. Many of them are made on credit. So we're going to take sales out of the equation as we recorded them and add back the cash collected against sales and accounts receivable. This is cash from sales across the counter, if you're a business that has a sales counter in the office, and it's sales on accounts, it's collections, checks people send you from what they've owed you from prior shipments, all right? And that's the cash impact. So that reconciles the timing differences in your operating statement. Then we're going to take out our estimated tax payments. Remember, our EBITDA line is interest, earnings before interest, taxes, depreciation, and amortization. Those estimated tax payments that we make are accounted for here. Now, we make them periodically, although we accrue them according to our accounting principles every month. We don't actually pay them every month. We pay them every so often, usually quarterly. And that line item is in here in the forecast. Now, in addition to that, we also account for the changes in accounts payable. Now, our accounts payable number is what we owe to our vendors. And we built that number up to something over a period of time. And now, whether it goes up or it goes down, that up or down is really a cash effect, because if we pay down our accounts payable balance, we've actually spent cash out the door to do that. Similarly, if we let our accounts payable balance goes up, that means people have extended us more credit, in effect giving us their cash to work with. And that's why we have a change in accounts payable line here for you to enter in your forecast. Now, we've left a couple of other lines in here for things that may apply to your business specifically. We strike a total for section 4 there of all of our other timing differences and adjustments. And we come down to a line called net cash flow. That's right down here. You can see where I'm flashing the cursor. And that net cash flow is the sum of sections 1, 2, 3, and 4. All right. That is the net. After everything we did, that's our net cash flow expectation for the period. In this case, the month of January. Now, remember, We started up here with a $10,000 cash balance in January. Our net cash flow for the month was $905. We add that to the 10,000, and at the end of the month, lo and behold, we've got $10,905. Simple addition, right? Well, that $10,905 is what we start off the month of February with. 1 month end, next month begin, right? No time in between, no activity in between. So January 31st at midnight and February 1st at midnight, opening 1 second after midnight, that is when we account for our starting cash of $10,905. Now we just repeat this cycle each month as we go along, all right? And each month we come up with a cash flow number for the month, and then how that affects our cash flow, our cash balance at the end of the month. And again, as I said, there are 12 months in the template that the live template that you'll be getting. So as you can see, this business is doing pretty well. We go from $10,000 cash at the beginning of January to $30,845 cash at the end of June. All right. Your business may differ, of course, but that's how this example works. Now, the next two lines relate to something a lot of businesses do. A lot of businesses figure out what's the minimum cash balance I need in the bank in order to operate my business and guard against any unexpected sudden cash needs. A disaster, for example, an accident, something you didn't foresee, or a COVID-19 public health order that shuts your restaurant down completely. You want to have a cash balance, a minimum cash balance that will help you survive for at least a while and operate or determine what you're going to do next. And a lot of businesses set that minimum cash balance target. Some set it at a month's worth of operating expenses, for example, or a month's worth of total normal cash flow. In this case, this business has set its minimum cash balance target at $8,000 steadily each month all the way across. And then you can subtract your existing cash balance from that minimum and determine whether you have excess cash or a shortfall in cash. And this is where it gets really important, because now you can tell when you're going to need cash and when you're going to have excess cash. I was once in a business that made outdoor garden equipment, the famous Troy built rototillers, right? And we sold rototillers like mad from the end of February all the way to the end of May. And then everything stopped. But we still had expenses. So all that excess cash that came roaring in the door between February and May, we had budgeted that to use it at other points during the year. And we tracked our usage of that and our budgeting of that very carefully all the way through the year to make sure that we weren't going to be surprised by cash needs that didn't show up in our forecast. All right. We did forecast that in, for example, December and January and February, we were going to need to borrow against our bank line of credit in order to fund the production we were building up to inventory for that big selling season at the end, starting at the end of February. And our budgeting reflected that cash flow during the year. We tracked that cash flow every month very carefully. And in some cases, we would go to tracking it by week or by day, and we'll talk more about that a little later. But for now, this is the kind of forecasting template, forecasting tool that you can use to develop an idea of when you're going to have lots of cash and when you're going to need cash. I highly recommend it to you, as does Philip Campbell, the author. His book, Never Run Out of Cash, has an associated website called neverrunoutofcash.com. And you can go there to get a free copy of the book, which gives you much more detail about this topic. Now, I said we had to forecast it to have some funny idea of what we thought was going to happen. We need to track cash flow in order to have an understanding of what is happening. Any plan you make, any forecast you make is obsolete the moment your pencil leaves the paper or the moment your fingers rise off the keyboard from your Excel spreadsheet. But when you track, you know what's happening in the period that you're tracking for. All the major accounting software lets you make a P&L statement. It lets you create a balance sheet, and it also will produce a cash flow statement for you. All right. So if you keep your bookkeeping up to date religiously, you can get that cash flow statement that you need every month. All right. Track your business by the month. If it's a less active business, track it by the quarter. In an emergency, you might want to track it by the day or by the week of your normal period. Our marketing department at the Troy-Bilt company that I worked at would track results from marketing campaigns every day. They knew when they had put the campaign out. In our case, it was out in the mail. This is back in the 1980s when there was such a thing as direct mail marketing. And they knew from experience when they put that mail campaign out via the Postal Service, they knew when to expect orders to start coming in from it. And those orders would come in a predictable pattern over a period of time. And they would track those orders every day against what they expected to see every day. And if they started to see a trend diverging, either positively or negatively, they would be able to alert everyone that, hey, this is what we're seeing. Let's get ready to batten down the hatches, or hooray, we got a lot of orders in. This is fabulous. You should put another shift on in the factory. From time to time, we did that. So tracking it is critical, because when you track it, you can compare the track to the forecast and say, why are these different? And that does two things. Why are these different? Answering that question means you find out why you had more or less cash than you thought you did, or you thought you were going to, and why you had more or less cash than you thought you were going to. And once you know that, now you can do two things. You can take management steps to conserve your cash, or to invest it, or to set it aside for a future need. And you can also refine the assumptions in your forecast. And you update your forecast with those refined assumptions, and you roll that forecast forward. When I showed you the forecast spreadsheet, which says January through December, I didn't mean that you only create a forecast once a year. You should be updating that forecast every single month. So you have a rolling 12-month forecast forward. And by having that rolling forecast forward, you're looking out into the future. You're being proactive in your business by looking into the future to see when you're going to need cash and what you can do to ensure that you have the cash you need when you need it. Because remember, if you run out of cash, you crash. Now, tactically, what do you do? To accelerate cash flow in, that means getting it in the door faster. The first and best thing you can do to accelerate cash in the door is to mine your existing customer base and sell to them. Analyze existing customers, analyze their purchase patterns. Call to offer them more of what they've been buying, or related products that you have that can help their business. All right. And when you do that, you then offer them pricing discounts to get them to, impel them to buy, to motivate them to buy. And those discounts come with a fast payment, or cash with the order even. Okay. The old, remember that it's a fairly common term. If you sell to somebody on credit, you offer them a 2% discount for payment in 10 days. Okay. Well, you might offer them a 5% discount for cash with their order, right? But the cash comes in with the order. As you're selling, you have to continue marketing and prospecting for new customers. Your existing customer base will erode over time. Customers will retire, they'll die, they'll sell their business, they'll be persuaded by a competitor to go with the competitor instead of you. And so as that business erodes, you have to be constantly marketing and prospecting to new customers. So make sure that your marketing budgets, your sales budgets, include amounts to keep acquiring new customers. Now, I also tell people, just use one bank. You get faster availability of your funds if they all come into one bank at the same time. Okay. rather than having a satellite bank account in a different state for some reason, just to make customers think you actually have a presence there. There are reasons for doing that. There are reasons for not doing that. I tell people use one bank. Have all your customers send their payments one place. You get faster availability that way. Now, you also can accelerate cash coming in by borrowing. If you're selling on credit to your customers and you have accounts receivable that have a history and have a predictable pattern of payment, you can go to the bank and get a revolving line of credit, it's called, that you can draw on the same day you send the invoice to your customer. All right. And that speeds up your cash flow from your customers. Similarly, if you are buying a piece of capital equipment, you can go to the bank to finance that equipment and get a loan, usually with a level payment every month, that matches out to the estimated useful life of the equipment. All right. Or in most cases, somewhere between 5 and 9 years for capital equipment type purchases. Vehicles, 3 to 5 years, something like that, 4 to 6 years. I've even seen car loans advertised recently that have 72-month payments, which is 6 years. But that's for paying for long-lived assets. All right. Revolving loan lines of credit lets you draw them down and pay them back anytime as your cash flow needs dictate. Also, to accelerate your cash in, look at your accounts receivable and look at your whole process of selling on credit. Collect your receivables faster by using professional collection techniques. These include, for example, analyzing your customers' credit usage and perhaps tightening credit requirements. By reducing their open to buy, you force them to pay you more often to stay within that open credit limit. On some customers, they may be poor payers by your standards, and you might say, I'm sorry, I can't afford to offer you credit anymore. I will take credit cards from you with your order. Or I will take a check on delivery, which is a form of credit after all, because you're covering the period of time between when it leaves your dock and when the customer check gets back and clears the bank. All right. Call your customers, follow up with them, talk to them, develop a relationship over the phone that keeps you at the top of their mind. So when they're making decisions on who to pay, they're thinking of you first. All right. And this isn't calling to hector them to pay you or to threaten them with action or whatever. This is just calling to find out how their business is going along, developing a relationship with them that's beyond just, are you going to pay me today? All right. And so that's why you want to be in communication with them. Communication is the key to all of these techniques. And communication is based on information. The information you have to talk to them comes from your forecasting of cash flow and your tracking of cash flow. All right. And your understanding of your customer and what their business is like and how their business is doing. Now, I mentioned revolving lines of credit. There's also another type of short-term financing for receivables that is very expensive and not commonly used outside of just a couple of industries. And it's called factoring. This is very common in the fashion industry. In factoring, a factoring company buys your invoice that you sent to your customer, and the customer is then responsible for paying the factoring company directly. Now, to do this, they discount that invoice. They pay you less than the face value of it. And that accounts for two things. It accounts for the factoring company's time value of money and their profit margin. And because factoring is sort of a last resort credit kind of thing, they make a lot of money on it because there's a lot of risk involved in it. All right. Because if you're in the fashion business, for example, some of your fashion customers you may ship for the fall collection. They may sell it, but not make any money and go out of business. They're never going to pay you. All right. So you got to be aware of that. And factors are very aware of that, especially in the fashion industry, which is where its principal use is. Also, accelerate your cash flow in by using a lockbox service. Have your customers send their checks straight to the bank. The bank processes the check and then sends you all the information it got from your customer, so you can update your records later. Don't take checks to your office today, process them through your system tomorrow, and then take them to the bank on the third day that they've been in your house. All right? Have them come straight to the bank. You get 2 days faster availability. Now, this may not seem like much, but if you're dealing in millions and millions of dollars every day, it does add up, because you can invest that money sometimes and get a little bit of interest off it. It's low these days, but it is interest, and get a little interest off it between the time that it comes in and the time you need to use it. All right. Now, decelerating cash out. In the same way that you analyze your customers' invoices and your customers' patterns of payment, you have to analyze your vendor file and your vendor payment patterns. And you analyze that list carefully. You're looking for the people you have to pay and have to stay on good terms with if your business is going to keep getting shipments from them and keep going forward. All right. So you analyze your vendor list. A lot of people break it down into A's and B's and C's. I got to pay my A's. I can talk to my B's and slow them down a little bit. And my C's aren't really necessary very often. So I can talk to them and I can slow them down. And if they get mad at me, well, the world won't fall in. But the key to all this is to communicate. You've got to tell your story. Again, communication is based on information. Information is based on data. Your forecast and your tracking drive your information and drive your communication. You need to tell your story to your vendor, all right, to the people offering you credit. And by telling them your story and telling them that, for example, my cash flow forecast says I'm going to be short this month. Can I slow down and pay you for everything by the end of the next month when I do expect to have all the cash that I'm going to need? All right. That tells your vendor that you're on top of your business, that you're on top of your financial management responsibilities, and that you're actively trying to stay current and you're actively trying to manage your responsibilities. That tends to give them confidence in you. And that confidence is enough to keep them shipping to you, because they know you have your business under control because you're tracking and forecasting what it is you're going to do. Communication is critical. It is the key to all of this. Now, in the same way, you talk about cutting expenses. That's easy for me to say, you might think, but you do have to analyze your expense ledger carefully, just the same way you analyzed your vendor file. Analyze your payroll carefully. Look at your outsourcing opportunities. These days, you can outsource almost everything associated with a business. But what you need to do first is to look at your business and find out where it is that you add the value of your business to your customer. What is it that you do that has your customer dealing with you? Your customer is probably not dealing with you because you've got a stellar accounting department. They're probably not dealing with you because you've got a stellar shipping department. They're probably dealing with you because you offer them something they can't get elsewhere at the same price. And that specific value added item is the one you should keep in your business and keep your tightest control over. Almost everything else, accounting, human resources, shipping, fulfillment, warehousing, marketing, advertising, sometimes even sales, can be outsourced. But whatever it is that's at the core of your business, the core of the value you provide your customer, that's what you keep hold of. Now, when you analyze your expense ledger, you obviously want to look at things you have to do now to stay in business, to keep serving your customers, and the things that you could put off a little bit. You could delay them temporarily. And then there are those things that you do that, well, maybe we can't do those for the foreseeable future. And you just have to make those decisions. And when it comes to payroll, the same thing applies. can we do without what this position is doing? As somebody who's been in that position, it is the hardest job you will ever have to do in business, to sit down with a good performing employee, a nice person, and tell them you no longer have a job for them. It's not their fault. They didn't screw up. It's just that the business can't afford to have them on the payroll anymore. And that is tough to do. But if it's a case of your business surviving, it's something you have to do. Now, do without, I've mentioned that a couple of times. And then finally, down there at the bottom, again, I want to remind you, don't eliminate marketing. The first thing that happens when you eliminate marketing and advertising is your competitors all talk to your customers and say, gee, where did Joe Blow go? I don't see his advertising anymore. He's not advertising, he's not marketing, he's not. Have you talked to him lately? Have you seen anybody from him lately? Have you heard from him lately? Don't eliminate your marketing function, because it takes you out of the view, and the old adage, out of sight, out of mind, applies again. So keep that in mind. Now, in an emergency, bets are off in an emergency. You've got to decelerate your cash out first. That involves not just conversations with your vendors, it involves serious negotiations with your vendors. In all cases, you should be trying to delay and catch up later. Get headroom, get space, okay? Same thing with your landlord, negotiate with your landlord. Can we not pay you rent for 3 months and then amortize the rent over the rest of the lease? Maybe there's a cost to that, all right, in a lease amendment. But the whole point is to delay and catch up later. Same thing with your bank. Is there some forbearance we can get on this loan for this period of time, after which we will catch it up either immediately or over a period of time? All right. Those all involve communication. Communication comes from what? I can hear all of you saying out there, information. Right. All right. Keep that in mind. You have to be able to communicate in order to do all this. Accelerate your cash coming in. Offer a prepaid, if you're in a service business, offer a prepaid service contract to your customers. I'll give you 12 months service for the price of 10 or 11, or I'll give you 14-month service for the price of 12. Whatever it is, you want cash with that order, cash with that contract. Similarly, for those of you who might have a subscription business model, prepaid subscriptions, offer them more time for a payment today. We'll extend your subscription for a year or a year and a half for the price of 8, 10, 12 months. Okay, if you pay now. Gift cards are really good in retail and restaurants. Push gift cards to your customers. Pay us now, we'll provide you the service or the goods later on. If you do business on contract with customers and you're entering new contracts, ask for an advance payment in the contract, a month up front, say. Now, this is perfectly reasonable to do, because in a lot of cases with a new contract, you have some new things you have to do to get ready to service that customer, and they're reasonable costs, reasonable startup costs of service, and you get that advance contract payment in. Similarly, if there's a disaster or relief or a grant program out there because of a pandemic like this one or any other emergency, take advantage of it. Google it, find out about it, find out all you can about it, see if you're eligible. Talk to the people who make the grants. Get an application, put it in, process it as fast as you can so that you get the money as quickly as possible. Yes, these take time. Don't set it aside because it takes time. Don't set it aside thinking, oh, that'll never happen. They'll take months and months and months to do it. Get going, and the sooner you get going on those, the sooner the cash will come in. Now, all of those programs, all of the things I've talked about, the forecasting, the tracking, the program, relief programs, they all depend on staying up to date in your bookkeeping. Your forecasting and tracking has to stay up to date. Your bookkeeping has to stay up to date. You can't just say, oh, I'll do the books next month. right? You won't have accurate data, which means you won't have accurate information, which means you won't be able to communicate realistically. So keep your basic bookkeeping up to date. Now, all of the relief programs that are out there, federal, state, city, they each have specific requirements. Here's what you can spend your money on. Here's what happens if you don't spend it right, okay? And be prepared to get audited, because all of those programs are going to want to send some guy around later to say, hey, we gave you this money under this program. Show us how you spent it. Did you spend it on the right things? All right. Now, one of the things modern computerized accounting systems allow you to do usually is to establish sub-accounts and identifiers so that you can tie specific things together. You can tie the money coming in from the PPP loan, for example, with how you spent the PPP loan money using those sub-accounts. All right. Same thing with the EIDL, same thing with city small business survival grant programs or state survival grant programs. You can make sure you track it that way. Now, you want to make sure you track it that way and that you file the original paperwork properly because of that expectation that you're going to get audited. Now, beyond just the entries in the books, you have to keep payroll records. You have to keep leases and utility bills and operating expense bills, invoices. What an auditor is always looking for is evidence of payment and receipt. And that's evidence from outside the business. That's a check made out by you, but sent to somebody and cashed by them at your bank and processed back through your bank. Or a receipt from someone that you made a payment to. Or the accounting dates for when you received money from your bank for a PPP loan, for example. All right. EIDL loans come straight from SBA. But remember, those all have to be filed and be accessible in a way that allows you to pick up a package and hand it to an auditor and say, here's where I got it. Here's what I spent it on in accordance with the grant or the loan. All right. Record keeping is really important. Work with your CPA or bookkeeper to do that. Okay. If you don't have an independent CPA, engage one. Get your bookkeeper up to speed on what's required. Make sure that they're understanding and make sure you supervise them so that they do these things and set these things up the proper way. Now, I'm not going to go into these resources in detail. They're on the copy of the slides that you're going to get from this program. Again, Philip Campbell's book, Never Run Out of Cash. COVID-19 business resources. I'm not going to go into these in detail. Contact information for SBDC is right there. Highly recommend you take advantage of that. The SBA.gov website and their phone number that's listed there is their disaster customer service line. It's probably busy thanks to Hurricane Ida. So you may not get through right away. That's not to say you shouldn't try to continue to get through if you need to get to them. Again, Philip Campbell wrote Never Run Out of Cash. His website, neverrunoutofcash.com, offers you a free electronic copy of the book, plus this template, which I hope that Leslie's already chatted over to you. The National Federation of Independent Businesses provided some of the information I'm using in preparing this program, as did Inc. magazine, which has a tremendous online archive of articles. The SCORE Association's Albuquerque chapter is the nation's largest small business counseling organization, and we are strategic partners with SBDC in the development and presentation of these programs. Now, those of you who have questions, this is where Leslie gets to break in and throw them all at me so that we can address what you think you need to know in addition to what we've talked about so far.
Okay, so while we're waiting for any questions that come in, I want to remind everyone on what's coming up. So we have tomorrow, Eric's 10 favorite phone apps for your business. We have a bilingual session on accessing financial resources. We have Eddie Midland coming up that's going to be talking about 3 steps to attracting and retaining customers. We have online videos coming up, how to work. This is all small business related, so it's all great for your business. How to work online videos, e-commerce and alternative selling methods, basic steps to starting a business. I'm also going to tell everyone that we are going to have Tommy again next week, which is great, because if you have any questions coming that you think of, come back to the next session. And then that way because sometimes you'll think of something and you'll be like, oh, why didn't I ask that? But luckily we have him back, so you can always bring your questions to him. Let me just read a couple of the comments. Amazing practical info as always. Thank you, Teddy. Carolyn says, great presentation, easy to understand by people who are not familiar with financial jargon, which is me. So thank you, I appreciate that. Looking forward to tomorrow's course. I'm glad that they're enjoying the webinars. And Brenda says, thank you kindly for the wealth of info. So you're on a roll today, Tommy.
Well, once you get me started, sometimes it's hard to stop.
And
trying to move the slide here a little bit.
I
want to thank
Teddy
everybody
says,
for your attention today.
yeah,
I'm sorry,
I truly appreciate the slides and the follow-up. So great. I'm glad everyone's getting it.
Great. That's great. Now let's talk about what's next a little bit briefly. You can take what you get today and go home and start now. The sooner you start forecasting, the sooner you start tracking. And we're right here at the start of September. So there's no excuse not to sit down and start your first 12-month rolling cash forecast going forward. Sit down, do it now. And that way you'll have it in hand and you'll be able to start tracking against it, and you'll be able to start doing some of these suggestions and some of these tactical things that we talked about. Don't wait for it. Keep it in the top of your mind. Keep today's program in the top of your mind and go do it now. Okay? Don't procrastinate. So also, I just want to point out that nmsbdc.org is your place to go for more training, business counseling, loan application assistance. They also have links to a variety of other resources to help your small business get better. Also, I want to not only thank you for your attendance, but also ask a favor. You're going to receive a survey about this program via email after we're done. Please fill it out. Your comments and other information help me to improve this seminar. And I'm really, really interested in your thoughts and reactions to this beyond just the chat stuff that you did today. And thank you very much for that. I do appreciate it. With that, if we don't have any late breaking questions, I'm just going to check the chat here for all that. Okay, there we go. And there's your link for course materials from us. Make sure you copy that down right away before this whole Zoom meeting ends. If there aren't any other questions, I want to thank you very much for your attendance today. That's the end of our presentation, and I look forward to seeing those of you who feel like coming back for some more of it as we go on through September. Thanks very much.
Thank you, Tommy. And you guys have a great rest of your week. See you next time. Bye.